Chapter 24, Budgetary Control and Responsibility Accounting. So in 23 we learned how to create a budget and set it up. So that's what you're doing during the planning cycle in the fall. So this is what happens when now you've got to the year and you're actually going through and you're running your business and you're making revenues and you're making expenditures, and at some point you've got to go through and compare what your actual results are with what you'd budgeted. So that's really what this chapter is talking about that. And they start off talking about something called static budgets. And you didn't know it when we were in 23, but we were creating a static budget. The idea in a static budget is that you have one number that doesn't change. So when we said that sales for a month were 10,000 units, and we did our whole master budget based upon that, you didn't want to do it again, right? Because you want to change it. So that became that number. But in a static budget, the problem you run into is everybody gets focused on just one number. And so the reality is that during the year, of course, we never hit that one number. You don't hit the exact sales, so all the expenses which were created off that sales aren't going to be exactly right. So, but everybody focuses on what that bottom line number is. So let me give you an example. What I'm going to be using, instead of the example in the chapter, I'm going to be using exercise 24/7, which is over, it's one of the homework assignments I've given you, which is over on page E 24/7 on page 1142. And they go through and they give you some expenses for the year, okay? And so I'm going to draw up what the static budget would look like, okay? So in this particular case, they're going through and they're saying, okay, we have 10,000 units. Is that right? 10,000? 100,000, my mistake. 100,000 units. 24/7 on page 1142. So that's how many units that we planned. So we did the static budget, we did it one time. And so in this particular case, we used that to come up with the cost of manufacturing. These are toaster ovens, okay? So we go through and we look at our cost and we say, okay, well, we have some variable cost. And those are manufacturing variable cost, admin varying cost, and selling variable cost. And then we have some fixed cost. And that includes some manufacturing fixed cost and some administrative fixed cost. Now when we did this budget, we went through and we said, you know, we think manufacturing costs are going to cost us about $6 a unit. So times 100,000 units, we came up with $600,000 was what we're going to spend for our manufacturing. And then our administration, we said it's going to cost us about $4 per unit. So if we have 100,000 units, we're going to spend $400,000 on variable administration. And then finally, our selling is going to cost us about $3 a unit. So we're going to spend $300,000 for selling. So if we add those all up, that's going to equal $1,300,000. That's our total variable cost. Our fixed costs are going to be $160,000 for our manufacturing and $80,000 for our administration, for a total of $240,000. So our total cost are, what are our total costs? $1,540,000. And so when we did our static budget, we said that's it. We're going to make our best guess is we're going to make 100,000 units. This is what it's going to cost us to make those units. Okay? And then we go through and we start running the year. Okay? Now here's the problem with that. The odds are we're not going to make exactly 100,000. We might make more or we might make less, right? So the problem with this is people get fixated. It's kind of like target fixation. If you are a mountain bike rider, you know that if you ride down a hill and you see in the middle of the trail a big rock, you don't look at the rock, because if you look at the rock, you're going to hit it. You look away from it. Same thing if you're a kayaker, you know, if you're going through white water and you see a big rapid, you don't look at the rapid because you'll go into it. You go to the right or left of it. So if you look at this all during the year, people forget, oh, there's assumptions, everything up here, what was based on the 100,000. They get focused on, I can't spend more than $1,560,000 or $1,540,000. That's my budget. So what happens if during the year, at the end of the year, I come in and my actual expenses are $1,610,000? That's what my actual expenses turned out to be at the end of the year. Because again, the flexible budget helps us know how we did after we've actually had results. Well, if I just looked at that, I'd say, that was my budget, this is what I actually spent. I was $70,000 negative. I was unfavorable. I did a terrible job, right? I did a horrible job. And your boss is going to yell at you and you're going to feel really, really bad. But the problem with that is, what is the problem with that? What does that not take into account?
How many variable costs?
How many units you made. I mean, I don't know how many units I made. Did I make more than 100? Did I make less than 100? I don't know. And so that's why we have the flexible budget. It keeps people from getting fixated on this one number, all right? So how do you do a flexible budget? Well, you kind of look at it this way. You take what normally would be your static budget, and then, you know how we had all that fun and we went through and we did that whole master budget? How much fun that was? We get to do that 25 times. No, we don't really do that, okay? Because people would quit budgeting if that was the case. Now what we do is we pick kind of like a high number and a low number. And so we go through and we say, you know, our best guess is 100,000. That's probably what our static budget would be. But maybe we might have to be as low as 90,000 units. But we also might be as high as 110. We think it's going to be somewhere in that range. And then so we use that production to then do a bracketing of what the number would be in those different levels. Now in order to do that, the book doesn't show this, but every time I've ever seen a flexible budget, it makes life a lot easier if you do a column over here called per unit for your variable cost. Because then, you know, if you're doing an Excel spreadsheet, it's a lot easier to do your calculation. So I read the numbers off, but before we were saying a manufacturing cost are $6 per unit, our admin costs are $4 per unit, and our selling costs were $3 per unit. These are all the variable costs, right? And remember, variable costs vary in total, but on a per unit basis, they stay the same. So this gave us a total of $13 per unit for our variable costs. We don't show the per unit for the fixed costs because they stay the same at any level of output, okay? So now, once I've done that, I can simply say, well, what would I spend if I had 90,000 units is what I'm planning? Well, then I just take the 90 times each of these, and that gives me my new number. So this becomes 540,000. This becomes 360,000. This becomes 270,000. And if I add these all up, I end up now with 1,170,000 for my variable cost. What are my fixed costs at 90,000 units?
Same.
Exactly the same, because fixed costs are the same, right? They don't change. So it becomes 240. And I add those together, and that gives me 1,410,000. So while my best case is I think I should spend 1,540,000, I might spend as low as 1,410,000 if I only make 90,000 units. And I do the same thing for 110. 110 times each one of these gives me what my expenses would be at that appropriate level. And then again, my fixed costs, they don't change, right? They stay the same. 160, 80. So it's 240. Those don't change for any level. And I add that up, that gives me 1,670,000. So that's what a flexible budget is. It gives us a range. Now we could do this for any number of units, okay? I mean, we could go through and do 80, and we could do 95. We could do it a lot of times. The book example I don't like because they do it like 8 times, okay? Nobody does it 8 times. You know, they always do best case, low, and high. But what's really helpful is, well, this is nice. Let's go back to our example here. Remember I said we had 1,610,000 is what we actually spent? Well, okay, we know that's not over or high, but it's not, and it's not under or low, but we don't know where that's at. Well, you ask, well, how many units did you produce? Well, what if I told you that we produced 106,000 units? So we actually made 106,000 units, and we actually spent 1,610,000. Well, you look at that and you go, okay, well, the 106 is somewhere between 100 and 110, and the 1,610,000 is somewhere between 1,540,000 and 1,670,000. So it sounds about right. But we can even be more precise, because we can use something called the flexible budget formula. Did a terrible job with my whiteboard management. I always do that. So what's the flexible budget formula? Okay, the flexible budget formula. It says we're going to take our budgeted fixed cost and we're going to add to that our budgeted variable cost per unit times the actual number of units. And by using that formula, we can go through and we can find out exactly how much we should have spent, using our budget numbers, for making 106,000 units. To the very unit. We could do 106,232 units. We could find the exact number. We can be so precise. So how would that work? Well, our number is going to be this. What was our budgeted fixed cost at any of these levels? 240. So we're going to have 240,000. We're going to add to that, what is our variable cost per unit?
13.
$13. And how many units are we saying that we made? We actually made 106, right? So we just multiply 106, because that should have cost us $13 for every one of those 106. And if we do the calculation, that works out to be, what does that work out to be? $1,618,000. So that would be our flexible budget at 106,000 production. If we had known back when we were doing our static budget that we were going to sell only 106,000, we would have put 106,000 and done our static budget, and we would have been at the right place. Okay, but of course we didn't know that back then. But now afterwards, we made 106. What should we have spent? So that's what we should have spent. So now when we go through and we do our calculation, this is our budget for that level. What was our actual cost that we spent? $1,610,000. So in this case, we're actually $8,000 what? Favorable. We actually made more. We made more units and we spent more, but on a budget basis, we actually spent less than we should have, okay? Over here, when we did it, it made us look bad because using the static budget, it looks like we'd spent a whole lot more money than we should have, but that's because we made a whole lot more units. So the flexible budget is one of those tools that's really, really helpful when you're getting ready to go through and explain budget variances and things during the year. Because really, people do. I've seen this in the real world. People get target fixation. They get to look at one number, and that number becomes the number you have to hit, and they forget all the other things that go on. So this helps remind us that other things are going on, and of course, if you're going to sell more, then you're probably going to spend more. Okay? Now, what you don't want is to sell less and spend more. Then if you do the flexible budget, you're going to look even worse than you did before. So you may not want to bring that up if that's your situation. But I'm not telling you how to play the numbers, but I'm just saying you ought to be aware, right?
But the actual, when it comes out the actual, what if you don't know it's 106,000?
Well, you'd know the actual because you're only doing this after you've finished a period of time. You know how much you really spent.
Right. And so you don't know how many units, though.
You would know. You would look back and say, well, how much did we spend last month? Well, we spent 1,610,000. How many units did we make? We made 106,000 units.
Right.
That's what we did last month. That's what we really did.
Oh, so
Well, how'd that compare to budget? Well,
Right.
now, how did I made those up.
Yeah.
I just gave those to you. On the test, I think it'd be kind of fun to have you do a flexible budget and then give you some numbers, actual sales and actual volume and actual cost, and see if you could tell me what the variance would be. I think that'd be kind of fun, don't you? I think it'd be fun. Yeah.
You change the costs in the problem, you're gonna give us actual cost changes?
Yeah, I'd go through and I'd have you do the flexible budget like this. I'd
Yeah.
give you variable cost and fixed cost and have you do this.
Mhm.
By the way, don't forget to put the fixed cost on the bottom. Somebody in the test always forgets to do that, so don't forget that. But then I'd go through and say, okay, at the end, now you've got this flexible budget. What are you going to do with it? Well, here's what your costs were. You spent $1,610,000 and you made 106,000 units. Were you better or worse than the plan? And you'd go, well, let me use my handy-dandy flexible budget. You plug in all the numbers. You say, as a matter of fact, we were $8,000 favorable or better because the budget says we should have spent $1,618,000. We only spent $1,610,000, so we were actually under what we would have been at this specific level of production. Okay. So that's the flexible budget. That's really the big piece in this chapter. Okay. The next part that it kind of goes into, it talks about responsibility accounting, and what it really is referring to there is the idea that, you know, most of us aren't going to be doing the whole flexible budget. We're going to be just doing one part, one little component. We're going to be in charge of a store or a division or a branch or something like that. And so they talk about responsibility accounting, and the idea is that an organization, the people at the top are responsible for the whole thing, but people down at different levels are only responsible for their particular areas. And so they talk about the idea of how to control those and how to manage those people. And on page 1120, they talk about a couple of concepts. First off, they talk about the idea of controllable versus non-controllable revenues and expenses. And what that means is whatever level you're looking at a responsibility center. So, for example, you know, when I was at Bank of America, we had branches, like 15 different private bank branches that we had. They were big branches. They weren't like a retail branch. They had like 100 people working there and dealt with big companies and everything like that. But those branches were each a different responsibility center. And then those all added up to the private bank, which is what we were, and we added that together. And then we were a division that sent that all up to the headquarters, which was then had included all the commercial lending and the retail lending and all the other areas. So each of those branches was like a subunit. Well, each of those units was a responsibility center. And so they had their own budgets for revenues and expenses. Well, the expenses that those managers could control and had control over were called controllable items. Now, what happens if corporate said, you know, we're going to allocate part of this liability insurance out to all the branches because we have to buy this big liability policy with the company. So every branch is going to have to pay $20,000 for a year for liability insurance. And they just say, we're going to allocate it out, put it in your budget. Well, the person that's in charge of that budget at the branch didn't have any control over that, right? So that's non-controllable. So the idea is you only want to make people accountable for the expenses that they can control or the revenues they can control. So controllable items are what the branch manager or what that responsibility center manager has control over. Okay? Non-controllable are things that they don't. So good budgeting says don't hold people accountable for things that they don't have control over. Only hold them accountable for controllable items. Okay. The other thing it talks about on page 1120 is the idea of performance evaluation. It talks about something called management by exception. And what that really means is most businesses, there's too much going on to look at every single item. So what we do is we look at the things that are unusual. And that's why we do the variances. We look for things that are higher or lower than our plan because that's an exception. And then we go and we look at those and we do more review to find out what happened to see if something needs to be corrected. Now, even there, you can't look at all the variances, so you only look at the variances they call material or significant. Immaterial are small things. Material are big things, things that make a difference to our organization. So when we go through all this budget analysis, we aren't going to look at every single number because we would just all go crazy. We're only going to look at those items where a number looks significantly different from what we had planned for, and that number is big enough that it makes us care about what's going on. Okay? So I wouldn't care about somebody's selling expenses being over $10 for a month, but I might care if they're 50% higher than they should have been. Okay? So those are just some concepts they talk about there in the budgeting. They talk about responsibility reporting on page 11, 23, and 24. Don't get too excited about that. I think I gave you a homework problem, but I'm not going to worry about that. That's not a testable item. You do need to know the types of responsibility centers that are listed over on page 11, 24. There's three types of centers, okay? Cost center, profit center, and investment center. And right over here. The idea again, cost center, profit center, and then investment center. And the idea is, again, we're looking at the small pieces of the organization where we're planning a budget for the different areas, and all those are going to add up to the master budget. Bless you. When we talk about a cost center, the managers there are only responsible for controlling cost. So this would be like somebody who's in a factory and they're in charge of production. They don't have to sell anything, they just have to make sure the costs are all under control. So they'd be a cost center. And so their purpose would be to try to make sure that their costs are appropriate for the level of output they're putting. When I was in finance in the bank, I was a cost center manager. So I had a department of people who worked for me, and I had expenses I had to control. I didn't have any revenues, I wasn't selling anything, but I had to make sure I didn't spend too much. So my budget was controlling cost. So that's what a cost center is. Manager only worries about controlling the cost. A profit center is where you worry about the cost, but you also worry about revenues. So think of somebody who, say, runs a branch of a retail organization. You know, the branch manager, they have costs and expenses they have to maintain and keep control, but they also have sales targets. And so when it's all done, they end up with a net income number. So they have a profit number they're working towards. So they're worried about both controlling the revenues and getting them at the right level or higher, and expenses, keeping them at the right level or lower, so their net income comes in where it should be. So a profit center has more things to worry about. Again, you only want to focus on the things the items that those managers have control over. Okay. The most complex one is an investment center. Because an investment center is a profit center, but in addition to having accountability and responsibility for revenues and expenses, the person that runs that center also is allowed to make investment choices, buy assets. And the reason for that is because you're investing the company's money or capital into these long-term assets, so we want to make sure that we have a good return on those. So the manager there is responsible for earning a profit by managing sales and revenue and expenses, but also responsible for making sure that the assets that are invested in that center are providing a good return for the company. So a good example of this is General Electric. General Electric, you've heard of them, right? Big company. They're really more like a big holding company because all the subsidiaries they have are pretty much independent companies. And they sit down, and the way they evaluate their companies is they look and see how much return, how much money they have invested in each one of those, what they paid for them or how much they've got tied up in assets. And then they go through and they see what the profits are, and if they don't get a good return, they will sell that division. So they might sell a chemical division if it's not doing a good return, then maybe it's only getting a 10% return. They say, you know, that's not a good return for us. Let's sell this and get the $35 million for it. We'll sell it to DuPont or another company, take that $35 million and give it to another subsidiary that's getting a 25% return. So they're constantly selling low return on investment parts of their business and using that money to put back into the high return. That's one of the reasons they've been so successful over the years. They've been able to maintain high profitability because they prune off the weak stuff and grow the strong stuff by doing that. So that's what an investment center is. Now, how do you tell how an investment center is doing? Well, that's what we get into in the last section, Learning Objective 4, where we talk about on page 1129, improving the return on investment, ROI. Okay? So ROI, you remember the ratios way back when we did the ratio chapter. You know, we talked about return being net income and all that kind of stuff. Well, here we talk about return being the return that we get. It's usually going to be a net income number, or it could be what we call a controllable margin. Now, controllable margin for an investment center differs a little bit from net income because what happens is we basically take out the expenses that they don't have control over. So if there's fixed expenses like that $20,000 worth of insurance I said that they got billed back to them, they didn't have any say over, when we calculate their return, we take that out of their net income. Now, not all companies do that. I'll tell you, when we did this at the bank, we didn't do that. We just said, what's your net income? And we didn't try to figure out if it was controllable or not. It was too much work to do that. And I guess I didn't even think about it, to be honest, but we probably didn't think, if we looked at it, that the amount of uncontrollable expenses were that great. So companies are going to vary. But the key is that when you calculate your return on investment, your ROI, you're looking for some return, and the formula they use is over on page 1128. It's going to be the controllable margin, or like I said, in some cases, a lot of companies just use net income by whatever the division is, divided by the assets. In this case, it's average operating assets. Now that gets to be kind of interesting as well because how do you calculate your average operating assets? Do you use the book assets, the book value? Do you use the fair market value? So the book talks a little bit about that. Most companies just use the book value off the balance sheet. Okay, so I think General Electric uses a value that's closer to the fair market value because they want to see what the return is. Because their idea is, if we're not getting a good return on what that's worth, we'll sell it for what it's worth and take that money and reinvest it into another company. So I think they use the fair market value. And so it's actually a harder, because fair market value tends to go up over time. That's actually a harder hurdle. It keeps going up as the assets go up. But their idea is, hey, if we're not getting a good return on those value of assets, we should sell those assets that are worth more and then reinvest that money. So I think they use a little bit different value. But we're not going to worry about that. You're going to be given the numbers. So how does it work? Well, if you see on page 1129, you see this little number here. I'm going to go through and just kind of write it in. You have a number where this is again, this is an investment center, so they're going to have revenue as well as cost to control. So they have sales of $2 million. And they have variable costs, VC, of $1,100,000. So their contribution margin, don't confuse this with controllable margin. I'm going to write it. Contribution margin is $900,000. And then they subtract from that the controllable fixed costs. So again, if anything is getting allocated and they don't have control, that gets taken out. So we're going to call it just fixed cost, make life easy. So that's $300,000. So we end up with a controllable margin of $600,000. Now, if we just stop there, we would be a profit center. We have revenues and we have expenses, and that's our net income. That's what we evaluate. But we want to also make an investment center. So now we come down here and we say, okay, what are our average operating assets? Well, in the example we have here, they say they're $5 million. And again, it's simple average, so if we have a beginning number and any number, we add them together and divide by 2. Nothing fancy there. And then so our ROI, or return on our investment, would be simply to divide the $600,000 controllable margin by the average operating assets, and it would be 12%. So it's nothing too terribly crazy. Now, they go through some examples here, and companies kind of say, okay, how do we go through and we project or see how our ROI could be improved? And so the way I like to do it, they don't really show you how to do that, but I like to go through and I like to say, this is kind of like what we call our base case if we were doing projections. So this might be our base case. And then we want to do like our alternative or our option. So what I do is I would go in and I'd write changes. And so let's just do the first one there they have on the bottom of page 1129. They say we're going to go through and we're going to increase sales by 10%. So I'd say, okay, the change is we're going to increase sales by 10%, right? So sales goes up by 10%. So 10% of 2 million is 200,000. So my new number becomes 2,200,000. This just makes me be able to see what changes need to be made. But now, notice that's all told me that I needed to change, but is there anything else I need to change?
Variable.
Yeah, because remember, variable costs go up and down with your sales. It doesn't tell me that, but this helps me see that. So, oh yeah, well, if my sales go up, my variable costs have to go up by 10%. So that means that's going to go up by 110, so that would be, oh gosh, 1 million, what is it, 210? It's getting late in the day, right? So then when I take my difference here, that's going to be 990, I think.
Yeah.
Okay. And then I just go through, because nothing else changed. So then I can do the rest of my calculation. And I end up with 690. That's my new controllable margin. I divide that. My operating assets didn't change. I could change my operating assets. By the way, that's how I make this go up, right? I make this number go up by either increasing my numerator, so making my controllable margin go up, or by decreasing my denominator, making my average assets go away. So if you can't increase your controllable margin, what you may think about is, do we need all these assets? Maybe we can get rid of some of these assets. That'll make your ROI go up. But in this case, I do my calculation, and it works out to be 13.8. Okay? So that's ROI. And this gets used a lot by companies, again, to go through and rank and evaluate different parts of the business. They also talk about something called residual income. And I'm not going to spend a lot of time on it, but I think it pops up probably on a problem here or there, maybe on a homework problem. It's over on page 1132. It's another way of looking at what we have here, only this, you notice, everything's done by a percentage. And most companies have a hurdle rate. You know, like I said, and they rank them. The higher returns are better than the lower returns. I think GE has a rule, it used to be it was 15%. If you were under 15%, there's a good chance you're going to get sold, because they just didn't want to have you because you weren't around that much. You didn't provide that much return to them. So that's usually based upon a percentage. Residual income looks at the amount of income that you have left over after providing a minimum level of return that the company wants to get. So on the example we'd have there, you'd take, this is another formula. Okay, so this is residual income. And so you're going to have controllable margin. And then you're going to subtract from that the minimum rate of return, which has to be given to you, that the company wants to get, times the average operating assets. So in this particular case, they have here, this isn't the same example we have over there, this is off of page 1132. They say, in this case, the company wants to earn at least 10%. That's the minimum they want to get on their assets. So this company wants a 10% return. This particular division of the company has $2 million that are invested in it. So if you look at that, that works out to be $200,000. The company is saying, you better provide at least $200,000 for us. How much was their contribution margin? Well, their contribution margin was $260,000. So in this case, the difference is $60,000 positive residual income. The idea is that over here we calculated residual income or controllable margin, okay? And we took controllable margin and divided by operating assets to see a rate. Over here, we take the controllable margin, which was 260 in this case, and then we say, okay, we want to get at least 10%. That's the minimum we want. So, can you get that? And if so, then how much more can you give me? The idea is, the more residual income we get, the better off we are. And so in this particular case, the company had $2 million invested in this division. They said, you better earn at least 10% or you're in trouble. So they earned, that would be $200,000. The company did earn more than $200,000. They earned $60,000 more, so they had that's how much over they were the minimum. Okay? It's, instead of looking at it as a percentage, you're looking at it as a dollar amount. So they're both doing the same thing. They're both helping you evaluate which companies are providing a better return on the assets that are being invested in that particular business. Is there one that's better than the other? No, different situations, different ones work better. It's a good idea to do them both. Sometimes you might not have as high a percentage on a project, but it might give you a whole lot more residual income. So you might be more interested in the amount of residual income you got than the fact that it's 0.5% lower than another project that's smaller. So this kind of takes into account the size of the projects. This doesn't really account for the project size. A small project can have a high ROI, but a big project might be a lower ROI, but it gives you a lot more residual income. So it's a good idea to look at both of them. Okay.
Is this on the test?
I'm guessing there's a chance that you might see a multiple choice question pop up on either or both of these.
But you give us all the numbers.
Yeah, you'd be given all the numbers. You basically just need to know this formula,
Yeah.
and you need to know this formula. Okay? All right, and that's pretty much chapter 24.